Welcome to our Money Insights webinar series. The topic for this webinar is personal risk insurance. I'll explain what it is, how it works, and whether or not you need it. Personal risk insurance provides a financial benefit in the event of you suffering a serious injury or illness or death. These insurances include life insurance, income protection insurance, and trauma insurance. To work out if you need personal risk insurance, you need to ask yourself two questions. The first is, if you were to die today, would your family's finances be secure for the rest of their lives? Or would your family struggle to pay the mortgage, school fees, grocery bills, and other expenses? The second question is, if you were to suffer a serious injury or illness and couldn't work for some time, could you afford to pay your mortgage and other living expenses while you were off work? If you answered yes to both questions, it means you are self-funded and you do not need personal risk insurance. However, if you answered no to one or both questions, it means you need to protect your family's financial future by transferring financial risk to an insurance company. So if you were to suffer a serious illness or injury or death, the insurance company would pay you or your family a lump sum or an ongoing income stream. Let's look at how that works. We'll start with life insurance. Life insurance is simple. It pays a lump sum on the death of the insured. If you were to die, your family could use that money to pay out your mortgage and other debt, and to create an income stream to fund their living expenses. In other words, life insurance financially protects your family if you were to die. It makes sense to have life insurance, but interestingly, a survey by Rice Walker Actuaries found that only 4 out of every 100 Australians have adequate life insurance, which means that 96 out of 100 do not, and they would therefore be in financial distress if the breadwinner died. Do you have enough life insurance? As a rough guide, this ready reckoner will help you calculate how much life insurance you and your spouse need. Let's now move on to income protection insurance. This insurance is designed to replace your income if you are unable to work due to sickness or injury. It provides a monthly payment of up to 75% of your pre-tax income. You can generally choose the waiting period. This is how long you must be unable to work before the insurance begins to pay you, and the benefit period, which is how long the policy will pay you for if you are unable to work. Importantly, the premiums for income protection insurance are usually tax deductible. The cost of this insurance varies based on the waiting period and the benefit period, your income and occupation. Most people will earn a fortune between now and when they retire, and yet many people fail to insure their most important asset, their ability to earn an income. This is despite statistics which show that every working Australian has a 1 in 3 chance of becoming disabled from a serious illness or injury for more than 3 months before reaching age 65. And more than half of all serious accidents happen outside of work, when workers' compensation generally doesn't apply. Unfortunately, a serious illness or injury could happen to you, and if it does, you need to make sure you can still pay for your living expenses. By the way, your ability to earn an income is very valuable. Have a look at this table to see how much income you might earn between now and when you retire. I'm sure you insure your car, and that's an asset that's worth a lot less than your ability to earn an income. For most people, risk insurance is surprisingly affordable, and in the case of income protection, it's also tax deductible. How much income protection do you need? As a general rule of thumb, you and your spouse should insure the maximum of 75% of your pre-tax income up to the age of 65. The waiting period can be extended until after your sick leave and long service leave will be exhausted, and this will reduce the cost of this insurance. The third type of risk insurance is called trauma insurance. This insurance pays you a lump sum on the diagnosis of a specified illness or injury, generally including heart attack, stroke, cancer, and paraplegia. This insurance was created when it was realised that medical advances were resulting in patients increasingly surviving major health problems, but that the financial cost of survival was prohibitively high for patients. For example, medical costs, medicine, time off work, rehabilitation, and so on. In other words, patients didn't lose their lives, they lost their life savings instead. The chances of suffering a trauma are, unfortunately, quite high. For example, for a 45-year-old, the risk of having a stroke before 85 is 1 in 4 for men and 1 in 5 for women. It is expected that 1 in 3 men and 1 in 4 women will be diagnosed with a cancer before age 75. And for a 40-year-old, the risk of coronary heart disease at some time in the future is 1 in 2 for men and 1 in 3 for women. How much trauma insurance do you need? You should consider purchasing enough trauma insurance to cover you and your spouse for meeting medical, pharmaceutical and rehabilitation costs not covered by your health fund, paying for a carer, funding modifications to your home that may be necessary due to permanent disability, for example, replacing stairs with ramps, repaying debt, topping up your income protection policy payments, and paying for extended time off work so you can fully recover before you return to work. Let's now look at how risk insurance fits into your financial plan. Typically, you would expect that you would grow your assets until you retire, and then those assets would be depleted over your retirement. And of course, you would earn an income up until your retirement. But what would happen if you were seriously injured or had a serious illness sometime in the future, or if you died? You would lose your ability to earn an income, and you or your family would have to draw down your assets to survive. Of course, your plans for a financially secure retirement for you and or your family would also disappear. That's where risk insurance comes in. It can fill the gap in assets, and it can replace your lost income. In other words, risk insurance can help you keep on track financially in case an unexpected tragedy causes you to lose the ability to earn an income. Thank you for watching our webinar on personal risk insurance. If you would like an obligation-free assessment of your risk insurance needs, please contact your financial advisor. For more information on risk insurance generally, please visit our website. Thank you.
This webinar is of a general nature only, and the performance figures presented are not indicative of future performance. Given that most people have fairly complex financial situations, you therefore shouldn't take this information as personal advice. Everyone has different financial situations and requires solutions and plans which are tailored to their individual situation, and we will be pleased to provide you with that personal advice if you wish.